Well, hello there. I'm Alec Hogg, and as you can see on screen, Justin Clark and Martin Freeman. Martin, I think we've got well, there's a bit of a bonus for you, isn't it? You don't have to get up before the crack of dawn to join us because we're doing it here in South Africa at 7 p.m. in the evening.
Alec, thanks so much for having me on today's webinar, and thanks especially for being accommodating with the time slot.
Well, Justin, I mean, really, we can't keep pushing him like this and getting it so early in the morning, can we? That was a little unfair.
No, that's great, Alec. Thanks for accommodating us in the evening. We've got a few people online, so clearly the evening works. I think we're going to have to keep you up at night, Alec, away from that nice glass of red wine.
Oh, yeah. Okay, so let's get into our fun evening tonight, and we really are going to have a little bit of fun. Justin, how do you want to handle this? Do you guys want to just tell me when to move the slides, and we can take it on that basis? Sorry, before I even go there, I made a big mistake. Stuart has to take us through the tech first. Stuart?
Thanks, Alec, and how's it, Martin and Justin? Just quickly, on the control panel on the right-hand side, if you can see three good-looking men on the screen and a presentation underneath them, and hear my voice loud and clear. Can you just give us a high five? There's a high five button on that control panel, just so that I know. There we go. I've got a few coming through, Alec. Please let me know if it is coming through loud and clear, and we'll try to fix that. And we do like to keep it conversational. There's a little questions drop bar on that same control panel. If you can put your questions in there when Alec goes through with Martin and Justin, and we'll get through to them quickly. Thanks very much, Alec.
Yeah, the questions are quite simple. On the control panel is a big question mark. If you click on that, you can type to your heart's content. Just remembering that I will only identify you by your first name, not your surname. So only your first name. So in other words, you stay unidentified, if you like, throughout the if you've got any tax issues or things like that. Okay, I see there's a little bit of feedback, Stu. Any thoughts on where that might be coming from?
I think it's Justin's side. Justin, you're going to monitor your volume, hey?
Right, I've turned it down a bit.
Okay, or brilliant, that'll help. And probably also mute yourself when you're not on the discussion. But anyway, okay, so let's OrbVest have been our partners at BizNews for a long time. I think that's pretty well known by our community. You now have, just by way of background, Martin, you're based in New York to look after the investments there. They are niched, they're focused in medical properties. How many in the portfolio? Last I looked, 13. You're up to number 39, but is that the number in total in the portfolio?
There's over 21 buildings and 1.5 million square feet that we have under management, and you'll see quite a quick acceleration over the coming months as we move beyond Medical 40.
Brilliant, yeah. So is this what we're going to talk about tonight?
Tonight we'll be talking about Medical 38 and 39, and a little bit of what's happening in the US.
Okay, Justin, over to you, sir.
So Justin, you didn't unmute yourself.
Yeah, Alec told me to mute myself, and now I'm caught out. Alec, while I was having fun with you guys at that fantastic conference in the Berg last week, Martin was unable to be there because he had to go to the Revista conference in California, which is absolutely fascinating. And I think maybe we should bring him in to talk a little bit about trends. I mean, it's really fascinating that we thought a year ago that commercial real estate was really going to be in for a pounding, and in fact the opposite is happening. So I think let's bring him in first.
Thanks, Justin. I know you guys swap notes all the time, but it's great, Martin, if you can share a little bit of your feedback with us and clearly and the BizNews community.
Well, I think to start off with, I just want to cover from a high level what's happening in the US. So the US at present is very well positioned. We're moving past COVID. We're about to go into spring, which is always a good time, and people start getting out and about. The economy remains very, very strong. Although equities are moving slightly sideways, the unemployment in this country is just staggering in terms of the amount of jobs that are still available in such low rates. And so, that continues to power the economy. The demand for products is strong. And so that is also just leading to a surge in construction and pretty much catching up on the backlog that occurred from COVID. So all around, the economy is very buoyant at the moment and strong.
What about inflation?
So inflation is the one thing that I think is on everyone's mind, and it's the continual discussion point. There are a number of experts. We had leading economists that came to the Revista conference who spoke on the topic. Many believe that it's transitory because you are really comparing the current rates to what it was the prior year when it was pretty subdued in a lot of areas in the economy. And so they do believe it's going to be transitory. However, they're saying that that is notwithstanding certain shocks that may come through, such as inflation in wages, number one, and then secondly, also other things like Ukraine and various conflicts and gas prices.
And Ukraine, did that cause a bit of a stir at the conference?
So at the moment now, it's actually not. And it's sad to say in a way that the world is concerned about what's going on in Ukraine and the potential contamination it may have in the world. But the reality is that the US is a spectator from the sidelines like many other countries and is resisting the previous scenarios of getting directly involved. So the impact at the moment is really minimal, other than, like the rest of you, what we are seeing on CNN and the higher gas prices which are pushing through at the pumps.
Okay, guys, as per usual, I have got control of the PowerPoint presentation. So shall we go on to the first slide?
Perfect. On to the first slide, which is inflation. So you can see that inflation certainly has, in the opinion of most economists, peaked and will start to trend down quite rapidly. I think the important thing is that, you know, people are asking the question is, will the supply chain around the world be sorted out, or is this going to linger for a little bit longer than we thought? Either way, the one thing that we've come to understand from the US banks is they generally are pretty fast with being on the pulse of what's happening. And so the rate increases that we saw last year, when certain debts were moving from around about 2.75% to 3%, up towards 3.5%, already took into account a number of the potential impacts of inflation. But again, it's something we've just got to keep our eye on from a real estate perspective. Whatever it is at the time that we acquire, we lock in the rate. So it doesn't really have an impact on us now, but more what's going to happen in the future. And bearing in mind, we hold it for 5 years. So who knows where we're going to be in 5 years' time? I don't think anybody could guess in the current world.
Martin, before we move off to that, I just had a look quickly at what NASDAQ was doing today, and I see it's down another 3%. So it's really having a torrid time in the past couple of days. Is this having any impact whatsoever on demand for OrbVest's products, or indeed for medical properties in the US?
Without any doubt, and it's significant. So maybe if we just go through to some of the other slides, we'll cover most of that, Alec. And so what you can see of what you just mentioned is that with the equities market potentially going sideways for the next 2 to 3 years, and that's not my opinion, it's what other people are saying, and with the flight to a safe environment, the amount of money pouring into real estate in the US is beyond staggering. It's absolutely billions. I think there was a discussion point at the Revista conference, which is the medical get-together of all the aggregators in the entire industry. And they were saying that I think BlackRock or Blackstone at the moment is, you know, raising $2 billion a month to pretty much deploy into real estate. And that's notwithstanding all the large players also coming along. So cap rates, or what I mean by cap rate is the price at which you buy or purchase the asset, have tended to be decreasing, which means that you are paying more for the property across the entire asset class in the US. That's from multifamily, industrial, you name it. Prices of assets are getting more expensive and returns are decreasing. So this just talks to the cap rates, and you can see it's across all the different classes. And I think that you're going to see this continue as people are moving more into the areas and the asset classes. You know, there are only so many assets. And as somebody mentioned last week, you can think about it almost as an auction. If you've got too much money coming into an asset class and too few assets, well, there's only one way those assets are going, and that's more expensive and up in price.
Martin, just explain that, please. It's for guys like you who deal with this all the time. It's obviously, you meat and potatoes. But for the rest of us, what is a cap rate? And when you say 280 to 300 basis points, what does all of that mean?
So a cap rate is essentially the measure at which you purchase a property. So for example, if you bought a $10 million building and you were buying it at a 6 cap rate, you would expect to earn 6% on your money in the year, net operating income. So what that means is if you had to just say, well, I'm happy to only earn 500,000, you would be essentially paying a different cap rate. And so that is really just the driver of the economy. In the US, the cap rates are driven pretty much off your net operating income, which means when it's higher, you pay more. When it's lower, you pay less. And it's also dependent, obviously, on the state. So for example, if you want to go to, Indiana or Chicago, you're going to pay a different cap rate to if you were in New York or a predominant place in Florida.
Got it.
I see Justin's trying to mention something. Justin?
You mentioned when you came back to Revista, Martin, that your the cap rates in certain states like California had dropped to in the region of 3.5% to 4%. There were transactions going down at that price. I mean, that's crazy. That means that people are prepared to buy a building, long-term investment, hard asset for a 3.5% yield.
It really is. It's across the entire ambit in the US. I think that if I can speak specifically about Revista and the conference I was at, there was every large player there who was pretty much either coming into the industry that had never been in the industry before, who were prepared to come in with the objective of building a $500 million portfolio, or they had 100, 200, 300 million of equity that they were looking to invest. So, it really does put a lot of pressure on the assets. And hence, for OrbVest, it creates a huge opportunity because the bulk of our deals are actually off market. So if you're able to get it off market and you're not bidding on the open, market for deals, it puts you at a distinct advantage. What you can see on the slide over here is the consistent increase in terms of the square feet in our space also. And that also talks to inflation. So if you talk about, in the past at levels of $16, $17, moving up to 21, if you look at it in absolute terms, it's not an astronomical increase, but it just shows the consistent increase over time. And especially with construction in the US proving to be so expensive, given the costs and also inflation, what it means is that rentals across all asset classes are going to increase. And for real estate owners, when your rental increase, remember it drives your net operating income, which means your building is worth more money. So a bit of inflation in our area is not a bad thing at all. In fact, that's where real estate owners really make their money. So just moving on to one of the last slides, and then I'm going to hand over to Justin. Again, just one of the 3 things for your listeners who don't really know much about healthcare or why we're in this space is because it's pretty simple to understand. They're sticky tenants. If you think about, we always say healthcare practitioner, they go into your community, they take space in a building, they sign long leases, they're profitable, they're part of the community, and they don't move generally. Then, of course, in the US, underpinning that is you've got an aging population, you've got migration out of the hospitals, and that's something we talk about a lot. I mean, Justin and I were talking this morning about, in the US now, there's certain places where you can go and literally have severe operations like part of your hip replaced and be out in that same afternoon. It's astounding what they can do in these kind of facilities now. And it continues to grow as technology grows. And then, of course, there's the entire growth of the GDP and the medical expenditure. So people overall prefer to go to a medical office building than a hospital, not only in the US, I think around the world. And then, of course, in a lot of the areas we are acquiring assets, it's in areas where there is significant population migration towards warmer environments and climates, and especially given the impact of COVID and that it's allowed people to work from wherever they want to.
Right, I think Mart, let me talk a little bit to these. Well, I'm going to bring you in because you've just come back from a trip around the States, and in fact, you visited both of these facilities and many of our other buildings. So if you don't mind, I will call you back in. Alec, I think one of the things that has been keeping us awake at night, should I say, not asleep at night, is the fact that these buildings are getting expensive. And we have a mandate only to buy buildings within a certain range. And that means that we have to generate 7+ cash on cash quarterly. And of course, we have to provide an IRR of over 10%. And if we're paying more for the buildings, at what point do we actually stop buying and just sit and wait? And I think that that did concern us a lot. And interestingly, we've just had a flurry of opportunity. And it's so interesting how this happens. So this particular building in Phoenix, Arizona, owned by an elderly doctor, has made friends with all the doctors in the practice. And now he says it's very difficult for him to manage the building because he can't increase their rents, he can't do anything, and he doesn't have time to attend to the beautification of it. So he's looking for somebody who can take it over from him and manage it, and he'll sign a lease and he'll stay there. And this is the sort of story that we really like. So this is how we find these off-market deals. And the other one, Martin, was somebody that you got to know through your network, who contacted you and said, I have a deal, and the particular buyer of this building has reneged on the deal, or they're trying to trade me, because this happens at the end, and Martin, you'll probably get into this a bit later. And so I want to cancel the deal if you'll take it. And so we were able to step into a deal that was already done. So these are how we find these opportunities, and it's really as a result of our network that we've grown over time. So if you'd like to pass, get on to the next slide, we'll just pass through this quite quickly, Alec.
Okay.
Part of our investment philosophy is that if we're looking for a building that's very sticky, that tenants don't move out of, we try and find buildings that are adjacent to or on the campus of an existing medical building. Yes, certainly there are some circumstances that we'll buy a building that is suburban, like the other one, but this is an absolute, for us, an absolute a slam dunk, if you want to use the American terminology. If you have a look at this slide here, you can see the blue 40th Street Medical Plaza, and the big building across the road from it, the white building, is of course 136 bed, the Scottsdale campus of that particular hospital. And if you look carefully, you'll see there's a lot of other medical facilities doing specialty work around that hospital. So it's a whole healthcare node, or campus as we like to call it. And I think this is very important, because when a lease comes up, the doctor won't go anywhere because of the hospital. When a vacancy comes available, there is another medical tenant ready to step into its place. So this is the really cool thing about medical. But you can move on, Alec. Just as a little bit of a summary, as I mentioned, the hospital next door, very important, makes the tenant sticky. This is right in our sweet spot. It's 40,000 square feet. We believe this is a very low risk area of the market to be in. There's a lot of demand for these type of buildings, but they are not quite, in the mom and pop area, which is the smaller ones. And the other thing is, if you remember correctly, when you're buying a commercial building, as Martin said earlier, you are effectively only paying for the rented space, because it's the income of the building is a factor of the cap rate. And that means, of course, that you've effectively only paid for 77% of this building. And the opportunity for us is that over the course of the next month, a couple of months, we will look at placing new tenants, medical tenants, into these vacant spaces. Mark, perhaps you'd like to talk about this building, because you particularly met some of the tenants, and I think it was very cool.
Yeah, so thanks, Justin. And, it was such a privilege to go to this building. You don't often get to meet the seller, as Justin outlined, because very often it'll go through, there's a buyer, there's a seller, it gets transacted through the attorneys, and that's that. So I had the pleasure of meeting Dr. Rodriguez from, Valley Surgical. And it was such an honor. The person is in a practice that has been around for 29 years. They're one of the most well-known surgical practices. They've got 16 physicians who do their surgeries across the road at the hospital. And, it was just so enlightening. They bought the building a few years ago with the view that it would house them and their practice. And then eventually he said I'm not very good at running a building. I can't go and negotiate with my friends who are across the corridor. And the second thing is that, whilst he's running around and being a surgeon, there's so many small things in the building that just get neglected. We were walking around For example, the entrance mats outside each person was a bit tacky and old. You know, it's so simple to just do cosmetic changes to buildings and to make them feel that tender loving care. And so with a number of these tenants here, they've been here a long time. I met the lady who owns Health for Life. She came out, she said, I've been here since 2009. I love this place, it's a great position. She said, all I want is, please help me with one thing. I want a monument sign outside the building. A monument is essentially your billboard, which shows the names. She said, because everybody else has got a monument sign up and down the road and we don't. So that's the kind of stuff we're going to bring to the building and make sure the tenants are happy, that they remain there, and that we also then fill up some more of the space and over time hopefully get rental increases.
Martin, before we go on, at the bottom there, the purchase is quite a big provision for tenant installation. Just
Yes.
explain that.
So what happens is that in a typical asset class in America, for example, office, etc., you'll give $20, $25, $30 per square tenant installation allowance. That means the amount you give the tenant to kit out their premises. And where landlords just don't get it is that in healthcare, you need to offer 50 because it's more expensive. I can tell you right now that in almost all cases, the $50 per square that you are giving doesn't touch sides. The tenant then comes in and probably spends a couple $100,000 themselves spending and putting in their own equipment and extra spends, especially if you think about people like dentists. And so it is completely proportional. It depends often on the number of tenants that are rolling over. If you've got a building where you've got tenants and we're holding it for 5 years, where the bulk of them are in for 8 or 10, well, then you've got very little TI because you don't expect new tenants coming.
TR meaning tenant installation. Okay, on to the next slide. Is that right, Justin? Yeah, I've unmuted you now. We're just getting a little bit of feedback there, Justin. Sorry. On to the next slide.
Yeah, as I mentioned, returns here, these buildings are getting a little more expensive. As you can see, we used to do 8% more comfortably. Now we are saying realistically we want to do 7, and then obviously it increments up. And then obviously over the period of the full ownership of the building, we're fairly confident that the return will be between 12 and 13%. Just remember, this is in US dollars, and it's before your South African tax. And then you've just spoken about the tenant installation, so I won't cover that. But let's move on, Alec. I think when we get into the next slide here, I like to just show some of these things because they're very important. When you're buying a building, you make your money when you buy it. If you buy it when it's too expensive, then you are not going to make money on that asset, and we as investors in the building are going to be in danger of not getting our returns. So we always look at these fundamentals, and this is why I always like to include these slides to show people. For example, in this particular area, the price per square foot of transactions that have happened, according to the OrbVest slide, I think it's just cut off the bottom there, is $377,000 per square foot. And we're buying this building at $168 per square foot. Why? Because of the vacancy. If it was full, then we would be paying more like that market price. So I think that's super important. And the other thing is cap rates. We were talking earlier on, Martin mentioning the cap rates are going down, which means buildings are getting more expensive. And we were talking about transactions going down at 4%. We're buying this at 6.86, which means much cheaper than other transactions are happening in the market. So super important to understand. You make money when you buy the building. So if you can carry on flipping.
Justin, I just want to jump in there and say one thing, that typically in the market at the moment, cap rates are between 5 and 6%. So whenever you find a building that is better than 6% or higher than 6%, it means you're getting it at a great price. And generally, you'll only get those kind of scenarios when you're buying it off market. So we're very proud of these kind of transactions.
So we don't have to spend a lot of time on this, Alec. I think the most important thing for an investor to understand is a lot of the expenses, which are in the top there, are part of the closing costs and external fees, for example, due diligence, capex that we allow for the building, third-party placement costs, which is finance, etc. And then you see your big chunk of tenant installation, which is a reserve. We don't spend that unless we need to. And then ultimately, we take all the costs of running the structure and the company over the full 5-year period, and we capitalize it and shove it there. So that's predominantly the costs that we burn. And then where we make our money is at the bottom of that slide. There is a 7% hurdle. If we can make more than 7%, then we take a split of 40% in this case, and we pay the investor 60%. So that's pretty much how it works in terms of where we win, and we say where you win, we win. You know, ultimately that's where we make money. And at the end of the transaction, when we sell the building again, we give 60% of the capital gross, and the value that we've managed to add to the building, we pay that over to the investor. And if you go to the next slide, I'll just show you roughly to give you an idea how the returns kind of work on this building. So you see we've kind of cushioned the returns. So they start at 7.1 and ramp up slowly. So that is the line that says cash flow and return, the 7.1. And we're just assuming that for a $10,000 investment, you would earn in year one 714, etc. And then down the bottom, and bear in mind, if you are in South Africa, then you'll be investing as an international investor, and that's a return of 11 to 12%. And I think what's super important for us to mention here is that it's complicated, guys, investing in the US in real estate. And the structure we've come up with is super efficient, and there's very little leakage to all the various taxes and things that you would have in the US if you were making the direct investment. So, you know, again, 11 to 12%, you'll see this sort of common sort of range that we aim at, and I think that's all we need to talk about there for now, Alec. So this is the second building, and you know, we love these beautiful buildings when we can find them, but it's very unusual that we find a beautiful building that is also medical and that also has a little bit of value add. So this building is in Boynton Beach, which Martin, come and tell us again. You were there 2 weeks ago at this building, so talk to us about your impressions.
Yeah, so I think both of these buildings are exceptionally good value. I think both of them are in different places, and we forgot to mention also one thing, Justin, that Phoenix, Arizona is just absolutely exploding at the moment. I mean, the growth in that place is phenomenal. And so there's a lot of people chasing down assets over there. So it really is a great opportunity for people to invest into. And again, we must mention from as little as $5,000 up to $1 million or more. You know, so the average is a lot higher than 5,000, but it's just our entry point. This particular building is in Boynton Beach. We are very familiar as South Africans to Florida and to areas like Boca and Delray, where a lot of South Africans either have visited or moved to. And in particular, that hub, which includes Boynton Beach, is just absolutely experiencing migration on a phenomenal rate, and which is pushing up house prices and the prices of all assets. So we found this asset right next to the Boynton Mall. It is in a great location. It's a beautiful building. It's well tenanted. It's 95% leased. And so it really is one of the great assets that I think OrbVest could end up holding for a significant amount of time. The investment period on this building, as it stands right now, to the current investors that would go in, is 5 years. And I think as we go through this, Alec, you'll see the various slides which are self-explanatory.
Martin, I'm sure there are others thinking the same way I'm thinking, but isn't Arizona in the middle of America? So why is it called Boynton Beach?
Sorry. So I was referring to the previous one, which was the 40th Street, which was in Arizona. This particular one is Boynton Beach, which is in Boynton Beach, which is Medical 39.
Okay, so where's Boynton Beach?
Boynton Beach is in, Justin, you want to take over here? You also can give your description. You've spent time down in Florida?
Oh, it's in Florida, sorry. Okay, so this is in Florida. The first one was in Arizona, just to get my geography right. Okie doke, all right. Okay, so we'll get back to Justin now. Justin?
I think he's saying you muted him again.
Yeah, I did mute him. There we go. Now he's unmuted.
He's shutting me up. Alec, yeah, I promise I'll be good. I won't say anything bad. You don't have to mute me. Yeah, but just to be absolutely clear, yeah, the other one is in Phoenix, Arizona, one of the big growth nodes of the US for reasons that Martin explained. This is an area that South Africans might very well know. Delray Beach, Boca Raton, a lot of South Africans live down there, especially up with the older Santon inhabitants that have moved to Florida. So yeah, very familiar to South Africans. In fact, the first word we got on this building was asking somebody to go and have a look at it for us before Martin got on the plane. So let's move on, Alec, before we get stuck in too much detail. I think what is super important to say is that over the last couple of days, in fact, since your conference, this building has predominantly been fully subscribed, and I say that so we don't disappoint anyone, Alec. And I think it's important for us to say that we've always stayed out of the US. We were always looking after emerging investors because of our background in South Africa. But because of the demand in the US, we kind of opened the door a little crack, and literally $3 million of equity has flowed into this deal over the last 2 weeks since we acquired it. So it really is it's predominantly fully subscribed. So we can fly through it fairly quickly. But again, it is actually 100% occupied. Martin said 95. In fact, it's 100% occupied. And again, in the sweet spot, 40,000 odd square feet. The value add in this one is that it's only 51% medical. We have a plan to push the tenants out that aren't medical and convert it to predominantly medical. We'll never get it to 100% medical, but certainly there are tenants that we're eyeing that we'd like to move out and bring in medical tenants. We before we acquire these buildings, we liaise with the brokers. Luckily, we're getting a nice network of brokers that we trust, and of course we get an indication of how easy it will be to replace the tenants here that are in the building when the leases come up. And I think that's important. Once again, IRR very similar to the other buildings, not much in it. 7 to 7.5, and 11 to 12 return over the period. But let's move on. I don't think that's super important, Alec. Again, the fundamentals I always talk to. $341 per square foot. Now this time it's fully let, this building, and it's 274. And you could see the quality of the building. So we really were surprised to find this building at this price, and it was over a 6% cap rate. Normally, any of these buildings that look great, you're paying a premium for. Once again, the opportunity was that Martin's friend, connection, phoned them and said, the deal is going sour. Do you want to step in? We'll cancel it. So we stepped into an existing deal, which is phenomenal. But we can move quickly, Alec. Yeah, again, other fundamentals, always what are the tenants paying? If the tenants are paying too much per square meter or per square foot, then you probably are going to come to the end of the period when you want to sell the building. There's going to be a correction. So here you can see the rent per square foot, and I've included this just because it's interesting. $23 per square foot on an average triple net lease in the whole Miami Metro, and we're paying, or our tenants are paying, an average of $18.95 or nearly $19 a square foot. So there's nice space to be able to push some of those leases up when we convert them to medical. Again, just something interesting for the audience. But you can move.
Justin, just to mention something for anybody investing in American real estate at this particular time. The one thing that is high on our minds is, as we spoke about originally, inflation. Now, if inflation is going to push through in certain sectors at 3 to 5%, normal increase in your rentals is generally 2 to 2.5. So if we get the luxury of having to bring tenants in when they roll over their leases, or new tenants in at rentals where the escalations are 3, 4, or 5%, you can see how it drives the value of the building. And so there's a number of people that are actually quite excited about inflation, specifically in the real estate market.
Justin?
Great. Thanks. Alec, can you hear me?
Yeah, we can. I'll just mute you when you're off, Mark, because we are getting a bit of feedback on it. It seems to be something with your settings, but no problem. It's very easy to do.
Yeah. Again, Alec, I want to leave more time for questions. I don't want to spend too much time on this deal. We did talk about how the expenses are stacked up on the right, the first block, to take the purchase price from 11 million to 12 million of total investment. That's all the costs for the full 5-year period, including the tenant installation and all of that. I think something we'll just talk about quickly is we always are fairly conservative with LTV. That means the amount of debt that you take relative to the an equity that's invested. And I think it's important to understand that, because remember that your cost of capital, even now, we are paying in the region of 3.5% for debt that we fix at that rate for 5 years. So inflation can go to 10% in the US, we will be paying 3.5% for 5 years. And I think that's very important to understand. And that's one of the reasons why these things are, such a good inflation hedge. We could crank that up to 70 or 80% of debt, but what would happen if there was a black swan event? So we take a conservative view, and we always are between 50 and 65 max. And then finally, the debt coverage ratio is another interesting number that you always look at in a commercial building. That means effectively how long would the net income of the building be able to cover the actual debt component of the building, if, for example, your tenants were disrupted by a pandemic. And I think that's 2.3 times is a very, very healthy ratio. So that's all we need to worry about there, Alec. I think everything is pretty much the same as the previous deal.
Justin, if I can just jump in here. So, we throw around terminology, and so often it's good just to remind ourselves that not everyone is used to investing in real estate. And so LTV just stands for loan to value. And then we also throw in here something called an IRR, or internal rate of return. What it really is just all the money you receive in terms of your dividends and your capital gain, if you express it as a percentage per year. So simplistically, if you earned 8% cash on cash and a 4% capital gain, it would mean you were earning 12% IRR a year in simplistic terms.
Right. We do have a lot of questions, Justin. So as you say, good to move through them. Anything you would like to talk to on this graph, on this chart rather?
No, I think let's just finish quickly this slide. We've only got another 1 or 2 slides to cover there, Alec, and then we can get to the questions, and we don't have to have PowerPoint anymore.
Okay.
And then, I just finally wanted to mention this is still our favorite product, Alec. And if you remember correctly, when we were selling to only high net worth individuals, it was all very well to be selling single buildings. But as financial advisors started to come in and offer, a pensioner, for example, an investment in a single building, we started to get very uncomfortable. And so we created these products where we took a small slither, which we bridged in each building, and then we lumped it together and put it into one particular investment, just like a building, but it's effectively a share of multiple buildings. So the best way I like to describe it is, instead of having whatever it is, 8 tenants as we had in the previous building, there may be 80 tenants that the income's coming from. So if any one tenant fails, there's absolutely no impact or a few basis points impact on your return. You won't notice it. Much more secure and much more reliable in terms of being able to absolutely hang your hat on that income. So we do have the 5th version of it, ODH5, which is still available, and we certainly like that for people that are slightly more risk averse. You can get a slight, better return if you go with the single buildings, but then you've got to build a portfolio. You can't just go into one building, otherwise you're taking a bit of risk. So that's it. You can mute me now.
How many buildings are in ODH5?
So we still will allow for slithers of buildings that are still to come. So we haven't fully subscribed, but at the moment, I think there's 8 buildings that there's already equity employed into those buildings. So there's already a spread of 8 buildings, and then we'll add to that as equity flows in. So we put it into the new investments.
And how does the projected rate of return compare with single buildings? In other words, here you're getting the benefit of diversification across, as you say, 8 buildings in the portfolio, whereas 38 and 39 are single buildings. So, is there much difference?
Now, that's a great question, because the only leakage here really, Alec, is the cost of administering and running a separate structure. So that would probably work out to be about 0.5 or 50 basis points to 100 basis points in total. And that means that you've got a leakage of 1%, but the underlying assets, some of the assets that are already in here are 8 and 12. So it brings it down to 7 and 10.5 or 7 and 11 actually. I think this one is still at 7 and 11, which is comparable to the single deals that we bring to the table right now. So if you think about it, it is that's why we say it's up. This is where we put Gran into.
This is what Gran, and there's your disclaimer, as you always ask for. Okay, let's get into the questions. Daphne's question is a broad one. Inflation, recession, and Ukraine. What are the effects been on the US investments that you've just been talking about?
So I think just again, reiterating that, I think that the impact on the investments so far has been probably the opposite of what one would expect. In fact, it's been a flight to the investments because people see real estate as a safe haven. And in fact, the more uncertainty that exists in the market, unfortunately, it's bringing more and more people into real estate, which is pushing up the prices. It's great for the investments we have, but ultimately, our goal is to really build this portfolio significantly going forward. But again, Alec, all of this presupposes the fact that can you get good deals? And no matter what the market is, we continue to have a great network. I spend a lot of time flying around the US and meeting people and getting off-market deals. And as long as I'm able to do that, you're staying one step ahead of the opposition.
Martin, if you weren't based in the US, clearly those deals wouldn't come across your desk that often.
In fact, you wouldn't get them. You wouldn't get them, full stop. I mean, a lot of this is driven off relationships. Yes, you can get some deals. They're not going to be that competitive. And so it is absolutely imperative. And when things come about in a competitive market, the one thing that everybody says to me is, give me an answer quickly, act swiftly, don't let me down.
How long have you been in the US now?
It's now going to be going on 5 years.
Okay, so very settled in there. Revere's question is, how long before these buildings close? I guess, Justin, I have unmuted you.
Yeah, no, that's a great question. Just so people do understand, we allow a period that we get subscriptions in for the building, and then when it's fully subscribed, then we go to list. The closing runs independently, because whether we raise the money or not, we still close on the building at the set date. We have to do that, otherwise our reputation gets destroyed. So the closing on these buildings are, I think, offhand, the Boynton building is in about 30 days time, and the other one is in about 40 days time. So those are the closing dates. I think the most important thing for an investor to think about is actually the listing date, because that's when your investment starts to pay dividends. Bear in mind, before that period, from closing to listing, we actually pay you interest anyway on your money, because it's already been employed into the building.
But if I understand you correctly, it's 30 odd days. It's not a long time.
Yeah, we don't have the flexibility on it, just to be very clear, because it's contractual. It's part of the purchase sale agreement.
Okay. Graham asks, I'm a South African citizen with some investments in OrbVest projects. On my death, can you confirm that the funds will or can be transferred to my wife in terms of my will without massive situs taxes?
Yes, I think the answer to that is that a situs shouldn't apply, because remember that the investment is it's consolidated through our listed structure, which we use an exchange in the Seychelles, which is a tax-free island. So ultimately, he's actually investing in the Seychelles, and there is there's no tax effectively in the Seychelles. We have dealt with all the tax in the US, and remember that the Seychelles entity invests with one check into the ultimate SPV or where the building is held. So that's how we solve that problem. But I think you just need to get some proper tax advice, because if you have assets in a foreign jurisdiction and you want to be absolutely careful, you should have a will and a lost will and testament in that country. But there are arrangements that can be made with our broker dealer PKF Capital. So I suggest, is it Graham, that you engage with us offline, and we can help you to solve that problem.
Yeah, good call. When you're talking about big numbers, or particularly estate planning, you need to get the advice, don't you, Justin, of the experts. Just make sure, just then you can sleep at night, as Warren Buffett says. Revere asks another question. How do rental increases work in long leases? Are they set with the lease or can they increase with the market?
So it's interesting is that the escalations, as they're called, are always set up front together with the options. So if you sign typically in healthcare, between a 5 and a 10-year lease, because remember, it's different to a residential. Residential, think about it. Somebody wants to move out and they want to go and buy their own home someday or move around. In healthcare, you don't want to move around because that's where all your patients and your clients come to, your premises. So it's set up front. What's actually happening at the moment right now is that we're seeing an amendment come through in a number of leases that says it is between 2.5 going upwards to sometimes 3 and CPR. So they're starting to introduce CPR, given that fact that there's concerns around inflation, which either way is good for the landlord, protects the landlord.
Vaynant's question is, was the valuation not done using a fully let NOI? What is an NOI, first of all, Martin?
So NOI is net operating income.
Okay. With a normalized vacancy of, say, 5%. If a vacancy of 33% was applied to the valuation, then there's huge upside in the deal, or am I missing something?
So in a building, you're absolutely right. What happens is that even if your building is 100%, the banks, for example, will discount it down to 95 anyway. So in fact, there's the notion of even if you lease your building up 100%, you're not really going to maximize the value on it. So there's always a negotiation between buyer and seller. What it means is that if you buy a building and Vaynant's is 100%, that is 70% leased, and there's a 30% vacancy, and you then lease it up, there is enormous upside in that project. Hence the reason why, for example, in Arizona, you're quite right, Boynton, why we like those kind of buildings where there is a little bit of upside.
Richard's question is, included in the due diligence fee is a cost, or is there a cost for an independent valuation?
There is always an independent valuation. Number 2, the banks will ensure that they get a BOV, which is a valuation on the building, because they want to make sure that they're giving you the correct mortgage relative to the price of the building. So behind the scenes, the reason why there is 30 days of due diligence is you have to get various kind of reports, environmental surveys sometimes, etc. You have to get external leasing companies that will validate the leases and verify that everything is in order. And then the buyer has to go through also tenant interviews, where you go and physically speak to each tenant one by one and gain certain documentation from them. So it's a very complicated process. And that's the reason why to buy US real estate is not only complicated, it takes a long time.
Zan asks, why are returns smaller for international investors versus US investors? Martin?
Justin.
Okay, let me unmute Justin. There we go, Justin. You are unmuted. Oh, just about.
There
we go.
I've got it. It came up with a pop-up there for some reason, Alec. Yeah, so now over all that unmuting and muting, I've just missed the question.
Why are the returns smaller for international investors than US investors?
Got it. Okay. So remember that the US investors are earning a net return, which is paid directly to them, and they have to be, they're responsible for paying their local taxes. If you're a US investor, you'll be familiar with the K1 tax return that you get. You would have to obviously submit your local taxes and pay whatever tax there is on your capital gain, less whatever depreciation. It's fairly complicated in the US. As an international investor, remember that there's additional taxes. For example, there is a tax when you remove your capital from the country, or you take any capital or interest or dividends out of the country. And so apart from capital gains tax, there is that what's called withholding tax. And then of course, we pay all those taxes in the US on your behalf. And that's why I say this thing is so efficient, because the leakage is 1%. for us to do all of that, sort all those taxes out. The cash that you earn, the net amount that you earn, that we quote, if it's whatever, let's say 7% cash on cash, that is actually what you get in your trading account, or as we call it, wallet, that you get into your wallet as a net amount. Now, it's very important, and we don't give tax advice, but if you're a South African investor, your tax on a dividend is a maximum of 20%, and so ultimately you'll be paying a 20% tax in South Africa when you declare that on your tax return. But as I say, please don't take my advice. We are not tax advisors. Go to your independent advisor.
5 minutes for questions. See how we can close. Yeah, of course, Martin.
I could just jump in there and just say one thing is that, Justin said it eloquently, and I'll just reiterate. Taxation in the US is very complicated. So you're basically paying someone in the US gross via what's known as a K1. The reason why I hand it over to Justin is because Justin manages all our investors in South Africa and around the world. And so he eloquently answers the questions and manages them post this call. So that's why I like to defer to Justin whenever it gets to the South African type environment or specifics around Seychelles and what he says post this.
What investment tranches in OH5? And that's from Jane.
Well, the tranches, well, there's two sides. Number one, remember you can invest in any of our buildings from $5,000 upwards to $1 million or multi-millions, which some people do. And then in terms of the actual slither of each building, what we do is we take a percentage of each building, bearing in mind that we have to balance it between investors around the world. We will always make sure South African investors get a piece of each building, and then ODH needs to get a piece of each building. So that's pretty much how we cut it up. And if you're going to blame anyone if it's unfair cutting up, it's Justin's role.
Okay. Richard, another question. What is the total value in US dollars of the portfolio today? And what is the overall debt equity ratio? That's a nice one. You can brag a bit, maybe, Martin.
So it's over $400 million, the total portfolio. In terms of equity, you can assume it's around about a third. And that is going to scale by, I would say, about $100 to $150 million per year going forward. At this rate right now, we're on track to do about a building a month. And the only difference is that as we open the doors in America, it's actually quite interesting. American investors will not invest in any building unless they're writing a check between 5 and 10 million US dollars in the building. So you can understand that the appetite for larger buildings is significant, and they like what we're doing. And so don't be surprised if going forward, you see a number of key initiatives. The other thing I also want to mention, Alec, just for South Africans, is we have really spent a lot of time to try and open the door to give more access to our product to South Africans. And so watch this space where we try to lower the barriers to entry, and we'll see what we can do to bring more people into the net.
Now, we had a very a kind offer from your side around Christmas time when you allowed business community members to come in for $1,000. Are you talking about something like that, those kind of special offers, or are you going for something more permanent?
Well, I think what Justin and I would like to see is, really anyone who should be able to invest should be able to invest, notwithstanding minimums. The challenge is if you're going to be dealing with a lot of retail investors, it's around the complexity of being able to get their money seamlessly in and pay them back. And so I think that there's some discussions going on, and we would just like to be able to see a lot of South Africans come into products like ODH, because typically the reason we got into this is because the retail investor around the world can't access these kind of opportunities. Now we'd like to see if we can take it down to the next level and say, well, why can't someone below $5,000 or even $500 also not be able to invest into these kind of opportunities? And so we'll see where that goes.
You're pretty cool if you put in 100 Rand and get a slice of Medical 38 and tell your pals, yeah, I'm a slice of a building in Phoenix, Arizona. Hey, Justin.
Absolutely, Alec. And seeing as I'm unmuted, I'm going to grab the opportunity. Yeah, so I think and I forget the person's name who inquired about ODH. Super easy. If you want some help and advice on that, you can either email Martin at OrbVest.com, Justin at OrbVest.com, or support at OrbVest.com. and we can help you offline. We've got people all over South Africa that are equipped and qualified to help you. But I think, Alec, just important, I know we're closing now. How did this relationship start? It effectively started at BN1 when we met the partners. BN2, we had a serious conversation. And then finally, in this last one in the Berg last week, we managed to get off to I think the first step of the arrangement. And what it really is all about, for those that are getting very confused now, is we only do from $5,000. Bear in mind, we are an offshore company. You have to take your money offshore and invest it in the building offshore, and your money is effectively outside of the country. Now, that doesn't solve for a lot of people in South Africa, companies, trusts, small investors. So I think watch the space. Alec will definitely be talking about it, but it's certainly one of your friends and partners that we met at the BizNews conference, and they're going to be offering OrbVest products to small retail investors. And their whole pitch is obviously to democratize investment and take quality investment down to entry-level investors.
Oh, that's fantastic. And if they've been to the BizNews conference, then I know that they are reputable. Okay, last two. I know we just about run out of time now. Russell, his question is the cap rate used in the first Arizona building based on fully let income or on current occupancy? I think, again, he's saying, what's the upside?
So it is based on the current NOR. And so what you do is you base it on the current NOR, and then you lease up the building. And again, hopefully you get to 80–90%. But I think for us, it's more important than just the upside. As OrbVest, it's very important for people to understand our primary existence is around, first and foremost, the cash-on-cash dividends. And it's never a straight line. Make no mistake, there are always challenges and risks in any kind of investment. But hopefully in the bulk of our buildings, we do want to focus on that. And so I always say to people, if you're getting your 7 to 8% consistently over 5 years, and then you get upside at the end, that's great. And if you're getting double-digit returns and beyond, well, that really is fantastic in dollars. And so that's how we exist as OrbVest.
And Yetish is going to close us off tonight. His question is, what happens to the investment after the initial 5-year period?
After the initial 5-year period, we sell the building, just like we've acquired it on the open market, not off market, because I want as many bids as possible. And then what happens is we return the investment together with your profit back to all investors, and investors can take their money or they can decide to invest it into another building.
Justin, final word on your side?
Yeah, I'd like to add to that. I think, Alec, we try and run every building, in a kind of very democratic fashion. So we have had a couple of buildings that have come up recently. We've said, well, this is crazy, because if we found this building on the open market, we would be the buyer. And I'll tell you about it. Medical 7, we went back to the investors. We said, listen, we're up at the 5-year period. This is what the building is worth. Do you want us to sell it, or do you want us to keep your investment in, and we'll refinance you? We'll refinance the building, and we'll take some of the equity out, and we'll give it back to you, and then you keep the investment for another 5 years. And that we did. And we couldn't get anyone to exit. I think there was, $300,000 that we wanted more people to exit, actually, and they didn't. So I think that's super, because then those returns go up to cash on cash. I think that one is 9.8 cash on cash immediately after the refi, because remember, you've got some of your capital back. So, super deal if we do manage to keep the investment after the period.
Martin, your final comments before we close off?
Alec, I think as always, I just want to say thank you to you and your team for the support and for allowing us to do these kind of webinars. And just to everyone listening online, it really is so gratifying to receive compliments continually from people saying that they've invested now in US real estate, they get their dollar dividends, and that they are excited about being able to continue this process going forward. And that is what we essentially stand for. Thank you, Alec.
When was Medical 1?
The team, which is Henny and Michiel and Lowe, acquired Medical 1 in 2014.
Okay, so we're now talking about 8 years down the track, and you're at Medical 39, and as you were saying earlier, you're going to be accelerating now, $100 to $150 million a year. So by my calculations, you'll get to your $1 billion valuation in 2025. That could be quite a year.
Well, we'll do our best to see how the growth goes. We won't acquire buildings for the sake of just acquiring it. I think we need to be cognizant at all times that it's got to be done for the right building and for the right reason to hopefully get people to sleep well at night.
Thank you, Martin. Thank you, Justin. Stuart, when will the webinar be available for those who want to have a look at it again, or indeed those who might have missed out?
Thanks, Alec, and thanks, Martin and Justin. We'll get this up hopefully this evening, Alec. If not, it'll be first thing tomorrow morning on the BizNews TV channel on YouTube.
Brilliant. Well, thank you, Stu, Martin, Justin. It's, as always, been a lot of fun to be talking with the OrbVest team. Our partnership goes back many years now, and it's also gratifying for us, Justin, to hear that you might be democratizing even more due to connections that you made at the BizNews conference. So that's going to help me to sleep a little better tonight as well. Good talking with you again, and I'm so pleased you were at the conference in the Berg. Those who are listening now who haven't been to a BNC yet, we've got BNC 4 coming up in 30th of August and 2nd of September. We've got more than 100 bookings, and there's only 152 rooms, and it's just around the corner. Well, it's still 6 months off. So I would strongly recommend, if you're thinking of coming, please get hold of the guys at Champagne Sports and put your bookings in now. And as you heard from Justin, and Martin's also been there, it's quite an event, and it seems to be getting better and better, doesn't it, Justin?
Absolutely, Alec. I'm not just blowing smoke, but I really find it, one of the most enjoyable conferences that I can say that I've been to in many years. It's just such an amazing. I don't know. You've got a group of people that feel like a family. I know that sounds silly, but it's a very interesting tribe of people. Everyone is very friendly, and it's an amazing networking opportunity.
Yep, brilliant. Okay, gents, well, thanks again. Lovely being with you this evening. Lovely being with our BizNews community this evening as well. To everyone who attended, it looks like 7 o'clock on a Tuesday night is not a bad time slot to have. So, Martin, maybe we're going to stick to the evenings, and we won't have to stir you so early in the mornings in the future. But thanks again, and until the next time, cheerio.
Bye-bye.